ಎಲ್ಲರಿಗೂ ನಮಸ್ಕಾರ. ನನ್ನ ಹೆಸರು ರೂಪಾ ಪಿಸಿ, ಸಹಾಯಕ ಪ್ರಾಧ್ಯಾಪಕಿ, ಶ್ರೀ ಶಂಕರ ಆನಂದ್ ಸಿಂಗ್ ಗೌರ್ಮೆಂಟ್ ಫಸ್ಟ್ ಏಡ್ ಕಾಲೇಜ್ ಹೊಸಪೇಟೆ. ಈ ದಿನ ನಾವು ವಿಜಯನಗರ ಶ್ರೀಕೃಷ್ಣದೇವರಾಯ ಯೂನಿವರ್ಸಿಟಿಯ BCom 6ನೇ ಸೆಮಿಸ್ಟರ್ನ ಕಾಸ್ಟ್ ಅಕೌಂಟಿಂಗ್ ವಿಷಯದ ಮೊದಲ ಅಧ್ಯಾಯವಾದ ಯೂನಿಟ್ ಆರ್ ಔಟ್ಪುಟ್ ಕಾಸ್ಟಿಂಗ್ನ 9ನೇ ಸೆಷನ್ನನ್ನು ಡಿಸ್ಕಸ್ ಮಾಡೋಣ. ಈ ಸೆಷನ್ನಲ್ಲಿ ನಾವು ಎಸ್ಟಿಮೇಟ್ಸ್, ಟೆಂಡರ್ಸ್, ಕೊಟೇಷನ್ಸ್ ಬಗ್ಗೆ ತಿಳ್ಕೊಳ್ಳೋಣ ಹಾಗೂ ಅದರಲ್ಲಿ ಒಂದು ಪ್ರಾಬ್ಲಮನ್ನು ಸಾಲ್ವ್ ಮಾಡೋಣ. So what are estimates, tenders, quotations? Very often a manufacturer or producer is asked to submit a tender or cost estimate for the supply of product in future. The price quoted for future production is called quotation price or tender price. This price is ascertained on the basis of previous cost sheet or production account. The manufacturer has to ascertain and find out the possible changes in price of materials and rates of wages. Then he has to ascertain the amount of variable, semi-variable and fixed indirect expenses. He will also have to take into consideration the effects of loss of increasing and decreasing cost which might be applicable to the commodity which he has determined to produce. So then what are the requirements for the preparation of tenders or quotations? For the preparation of tender or quotation, a manufacturer must have detailed information regarding the cost of raw material, wages and the different overheads and the profit of the preceding period. It is only on the basis of the cost and profit data of the identical product produced in the immediate past period, a producer can make an estimate of the cost of the product after making adjustments for the likely changes in the price levels of the various components of the production and submit the tender or quotation for the goods. So overheads are absorbed on the basis of suitable method of absorption. In the absence of information about the method of absorption, percentage of works overhead to direct labor and percentage of office overheads to works overheads and percentage of selling and distribution overheads to works cost are to be considered. If the quantity is given and the method of absorption of overhead is not stated, the cost per unit of a past period should be considered for the current period with the necessary changes for the valuable changes of variable overheads. In case of fixed overheads, the total amount of fixed overheads of past period should be taken with the necessary changes. So then what are the steps for the preparation of estimated cost sheet? First step is preparation of cost sheet of the past period. Second step is calculation of overhead absorption rates if necessary. Third step is preparation of estimated cost sheet. So now let us know what are the overhead absorption rates. So first absorption rate is the factory overhead absorption rate. So first is percentage of factory overheads to direct wages. So if factory overhead percentage is to be taken, it has to be taken on the direct wages. So for that, factory overheads of the past period into 100 divided by direct wages of the past period. So then we will get the percentage and that percentage is to be applied on the estimated cost sheet. So second percentage is percentage of office overheads to works cost. So this can be calculated by office overheads of the past period into 100 divided by works cost of the past period. So next is percentage of selling and distribution overheads to works cost. So this is also calculated as under selling and distribution overhead for the past period into 100 divided by works cost for the past period, or it can also be calculated as selling and distribution overhead for the past period into 100 divided by cost of production for the past period. So next is estimation of the profit for the tender and quotation. So profit can be ascertained as a percentage of cost on sales, that is calculated as under profit for the past period into 100 divided by cost of sales for the past period. Otherwise, it can also be calculated as a percentage of profit on selling price or sales. So then it can be calculated as under profit for the past period divided by sales for the past period into 100. So now let us solve one problem. Following are the particulars for the production of 1500 machines of ABC Limited for the year 1999. Cost of materials 1,20,000, salaries 90,000, wages 1,80,000, factory expenses 75,000, rent, rates and insurance 15,000, sales expenses 45,000, general expenses 30,000, sales revenue 6 lakhs. So it is the information given about the manufacture of 1500 machines by ABC Limited in the year 1999. So here we have to prepare a cost sheet. This is the previous year cost sheet. We have to prepare a cost sheet for this, taking into consideration all this information. So they have given the 1500 machines, that is number of units is given. So we have to prepare a cost sheet taking into consideration the unit per unit column also. So cost of material should be taken under prime cost. Salaries is a administration overhead. Next, wages is a prime cost expense. Next, factory overhead. Factory expense is a factory overhead. Rent, rates and insurance come under administrative overhead. Sales expenses come under the selling and distribution overhead. General expenses come under the head administrative overhead. Sales revenue is the total sales revenue that should be taken at the last. So then the details are given. The sales manager of the company estimates that the sales during the year 2000 will be 2000 machines. Prepare a statement showing the estimated cost sheet for 2000 machines and the price per machine to earn a profit of 20% on selling price. So in the year 2000, the company will produce 2000 machines, and they have asked us to prepare a estimated cost sheet for 2000 machines, and the profit percentage should be 20% on selling price. So next, the following changes have been anticipated. What are the changes? So first one is rise in price of raw material by 20%. Wages will be up by 5%. Factory expenses will rise in proportion to combined cost of material and wages. So combined cost of material and wages means that is equal to prime cost. So next, selling and expenses per unit will remain the same. Other expenses will remain unaffected by the rise in output. So here the steps we have to remember. First, we have to prepare the cost sheet for the previous period, past period, and if necessary we have to calculate the percentage of absorption of overheads. So next, last step is to prepare the estimated cost sheet for the year 2000. So here the information they have given, the rise in price of raw material is by 20%. Wages will be up by 5%. So for before preparing the cost sheet for the previous year, so we should know what are the variable costs here. So variable costs they have given. If they have not also given, so we should consider material and wages as variable, always variable expenses, because so they the expense of material and wages will go up if the production increases, and will go down if the production decreases. So they are proportionately increasing and decreasing according to the output. So material and wages are always variable cost, and they should be taken per unit cost. So factory expenses they have given. So we have to calculate a percentage on the combined cost of the material and wages. So what is the percentage of factory overheads or factory expenses on the prime cost we have to calculate. And the selling expenses per unit will remain same, means selling expenses here they are considering it as a variable expense. Other expenses will remain unaffected by the rise in output. So other expenses means here we have salaries, rent rates and insurance, and general expenses. So all these are fixed expenses. So if they say they are unaffected by the rise in output, they are considered as the fixed expenses. So first we have to divide them into variable and fixed expenses. Here materials and wages are variable expenses. Factory expenses are absorbed according to the percentage, and selling expenses are variable as they have given per unit remains the same, and other expenses will remain unaffected, means by the rise in output, means they are fixed by nature. So first we will prepare the previous year cost sheet. ABC Limited, statement of cost for the year 1999. Production is 1500 units or machines in the year 1999. So here we have taken particulars column and total column and per unit column. Okay, first materials. So materials total is 1,20,000 they have given, and wages is 1,80,000. Yes, cost of material 1,20,000 and wages 1,80,000. So they have given for the total, and we have to calculate it for per unit. 1,20,000 divided by 1,500, it is 80 rupees per machine, and wages is 1,80,000. So that should be taken for per unit. That means 1,80,000 divided by 1,500 equal to 120 per unit. So there are no direct expenses. So it will be, the total will be the prime cost 1,20,000 plus 1,80,000, that is equal to 3 lakh. So total prime cost per unit is 80 plus 120 equal to 200. So next we will add the factory overheads. So here factory overheads are only the factory expenses. So factory expenses they have given 75,000. 75,000 is the total amount, and per unit cost will be 75,000 divided by 1,500. That is equal to 75,000 divided by 1,500 equal to 50. So total works cost will be 3 lakh plus 75,000. 3,75,000. Per unit cost will be 200 plus 50, 250. Works cost total is 3,75,000 and per unit is 250 per unit. So next we will add the administration overhead. So under administration overhead we have salaries, rent rates and insurance, and general expenses. So they have given for the total 90,000, 15,000 and 30,000 respectively. So per unit will be 90,000 divided by 1,500 equal to 60, 15,000 divided by 1,500 equal to 10, 30,000 divided by 1,500 equal to 20. So total cost of production will be 5,10,000 and per unit cost will be 340. So next we will add the selling and distribution overhead. Only sales expenses are there. Sales expenses. So sales expenses they have given 45,000. So 45,000. So 45,000 divided by 1,500 equal to 30. So cost of sales will be 5,10,000 plus 45,000, 5,55,000. So cost of sales per unit will be 340 plus 30, 370. So total sales revenue they have given 6 lakhs, and 6 lakhs we will take by leaving one line for the, so yes, sales revenues 6 lakh. One line for the profit, that is balancing figure. 6 lakhs minus 5,55,000, profit is the balancing figure 45,000, and here per unit is 6 lakh divided by 1,500 units, it is 400 per unit. So 400 minus 370, it is 30 per unit. So it is the cost sheet for the previous period. So taking into consideration all the data of the previous year cost sheet, we have to prepare the estimated cost sheet. So before that we will calculate the percentage or proportion of factory expenses to the combined cost of materials. See here, third one, factory expenses will rise in proportion to the combined cost of material and wages. So here material and wages represent the prime cost. So the the factory overhead expenses percentage will be calculated as under, yes, in note 1 we have calculated. So percentage of factory expenses to prime cost, factory expenses for the past period divided by prime cost for the past period into 100. So 75,000 was the factory expenses in 1999 and prime cost is 3 lakh. So 75,000 divided by 3 lakh into 100 equal to 25%. So 25% of prime cost will be the factory expenses. Okay, estimate for 2000 machines for the year 2000. So particulars, here is one column and total and per unit column. So per unit we have taken, yes, what is the first prime cost we will take. So what is the material cost? So material cost per unit, so we have to take the per unit cost because material is a variable cost as it increases or decreases by per unit. That means if we increase the production material cost will increase. If we decrease the production, the material cost will decrease. So it is a variable cost. So likewise wages also are variable cost. So we have to take all the variable cost per unit. So for that per unit we have to make additions and deductions. So per unit cost, as we have calculated earlier, per unit material cost is 80. So see here 80 per unit. So 80 per unit is the material cost. Yes. So material cost, for that we have to take into consideration the changes. So what is the change here? Rise in price of materials by 20%. So on that 80 rupees we have to take 20% increase. So 80 plus 20% of 80 is 16. So 80 plus 16 equal to 96 rupees per unit is the material cost per unit. So 96 per unit is the material cost, and for 2000 units 96 into 2000, so that will be 1,92,000. So likewise wages also, so the wages per unit was 120 per unit in the year 1999. So that will be up by 5%, means 120 into 5%, that is equal to 6 rupees. 120 plus 6 equal to 126 is the wages cost or labor cost per unit. So labor cost is 126 per unit into 2000 units or machines produced. So that will be 2,52,000. So only two costs are there in the prime cost, that is material and wages. So we have to add them, 1,92,000 plus 2,52,000, that is equal to 4,44,000 prime cost total, and per unit prime cost is 96 plus 126, 222 rupees per machine. So next we will add the works overhead. So works overhead, so we have calculated in the note. So calculation of percentage of factory overheads to combined cost of material and wages. Percentage of factory expenses is 25% on the prime cost. So here prime cost is 4,44,000. So on that we have to take the 25%. So 25% on 4,44,000 is 1,11,000. So 1,11,000 divided by 2000 equal to 55.50. So otherwise we can also calculate 222 divided by as 222 into 25%, that is also equal to 55.50. So total will be the works cost, that is prime cost plus works overhead, 4,44,000 plus 1,11,000, that is equal to 5,55,000 total works cost, and per unit works cost will be 222 plus 55.50, 277.50. So works cost is 5,55,000 total and per unit is 277.50. Next we will add the administrative overheads. So for the administrative overheads they have given Yes, all other expenses will remain unaffected by the rise in output. So all other expenses here, that means, so other than material, other than wages, other than factory expenses, other than selling expenses. So other than these expenses means salaries, rent, rates and insurance and general expenses. So all these represent the administrative overheads. So they will remain constant. So that means we have to take the total. So if they are considered as fixed overheads, so because so they have given, they do not, see here, other expenses will remain unaffected by the rise in output. That means they are fixed in nature. So we have to take into consideration the last year's figures only. Salaries 90,000, rent, rates and insurance 15,000 total, general expenses 30,000 total. As it is, we have taken. So per unit these expenses will differ because the number of units produced is different. So 90,000 divided by 2,000, that is equal to 45. So 15,000 divided by 2,000, 7.50. General expenses 30,000 divided by 2,000 units, 15 per machine. So cost of production will be works cost plus all these administrative overheads, that is equal to 5,55,000 plus 90,000 plus 15,000 plus 30,000, that is equal to 6,90,000. So per unit cost will be 345 per machine. Okay. So next we will add the selling and distribution overhead. For the selling and distribution overhead, they have given, we'll check the information. Selling expenses per unit will remain the same, they have given. So per unit selling expenses we have calculated in the year 1999 is 30 rupees per unit. See here, 30 rupees per unit. Per unit will remain the same means we have to take the per unit same. See, selling expenses 30 rupees per unit. So for the total of 2,000 machines, 30 into 2,000, that will be 60,000 total. So we will add the selling and distribution overhead, the cost of production 6,90,000 plus 60,000 to get the cost, total cost or cost of sales, that is equal to 7,50,000, and per unit is 345 plus 30, that is equal to 375. So what is the profit? Profit percentage we have calculated in note 2. So it is 20% on sales. So 20% on sales can be calculated as under profit equal to total cost into percentage of profit divided by 100 minus percentage of profit. So total cost we have calculated, here it is 7,50,000. So 7,50,000 is the total cost. 7,50,000 into percentage of profit is 20 divided by 100 minus 20. So that is equal to 7,50,000 into 20 divided by 80, that is profit equal to 1,87,500. So see here in note 2 we have written, so 1,87,500 is the total profit, and per unit profit is, it is divided by 2,000 units. So that is equal to 93.75. Okay. Total sales revenue will be cost of sales plus profit, that is equal to 7,50,000 plus 1,87,500 equal to 9,37,500, and per unit selling price will be 375 plus 93.75, that is equal to 468.75. So this is one problem regarding the estimates. Thank you.